How do you know if your business is sick? It's not just a feeling. There are key indicators that are hiding in your financial reports. So, are you looking at the right numbers? The same way that a doctor would evaluate your health based on running tests and asking you questions, we also need to evaluate the health of our business. To gather that information, we use our financial reports. By the way, I'm Jessica Lawrence, and I help entrepreneurs take control of their bookkeeping and their finances. So just like with our health, if our business is sick, we need to find out about it as soon as possible, because if we don't, then it's just going to keep getting worse and worse, and it'll be harder and harder to fix. So it's really important that we identify what the root causes are of any sickness, of any problems in our business, so that we can start fixing them and addressing it as soon as possible. So there are 3 financial reports that every business needs to be monitoring in order to know what the health of their business is. Let's start with the first, your profit and loss statement. Your profit and loss statement helps you identify the profitability of your business, right? So we look at the income coming into the business, we look at the expenses that are going out of the business, and we are able to see how profitable or how much we're losing each month. So my question to you is, are you operating at a net profit or at a net loss every month? If you are operating at a net loss, then we might need to really start taking a look at this. That is not a good indicator, right? It's a sign that we're not doing great and we're a little bit sick there. So if you're operating at a net profit, that would mean that your income is greater than your expenses. But if you're operating at a net loss, that means your expenses are greater than your income, right? And so sometimes this might happen for 1 month, but if it's happening for several months back to back, or even a whole year, this is going to significantly impact your business. The second financial report that we need to be monitoring is our balance sheet. The balance sheet helps you assess your business's financial health by looking at your assets, liabilities, and your equity. And if we have assets minus liabilities equal to a positive equity amount, then that's a good thing, right? We've got more in assets that we own than we do in liabilities that we owe. But if you have a negative net equity, or you have more in liabilities than you do in assets, that means that you actually owe more to other people than you own and could pay back. So, is the current equity in your business positive or negative? Because if it is negative and you owe more in liabilities than you do in assets, this is again an indication that something is up, something is wrong, and we need to start taking a look at what's going on for why we have more debt than we actually do in assets that we could use to pay it off. The third financial statement that we need to be monitoring is our cash flow statement. And this one is actually my favorite statement because it brings together information from both the profit and loss statement and from the balance sheet. So the cash flow statement helps you actually identify the cash flow of your business, right? True cash coming in and out of the business, not just money that's moving in and out of the business that might be in the form of credit cards, so loans, or other debt, but true cash. So this helps you identify how liquid you are. And this is something that is really important for the health of your business, because you want to know that you have some liquidity to be able to fall back on if something were to happen. So if you have negative cash flow, that means you've got more money and cash going out of your business than you have coming into the business, right? And we want it to be positive cash flow, where we have more money and cash coming into our business than we have going out. So that's the question for you. Do you have negative cash flow or positive cash flow? Because really, this is where you'll see liquidity or any solvency issues for a business. Now, in these 3 financial statements, we're going to want to track what we call KPIs, or key performance indicators. And we've already started talking about a few of these. Like for example, in the profit and loss statement, we're looking to see if there is a net profit or a net loss. When we're looking at the balance sheet, we're looking at the assets, we're looking at liabilities, and we're looking at equity and whether our equity is positive or negative. And in the cash flow statement, we're looking to see if there's positive cash flow or if there's negative cash flow. But in addition to that, there are all these other key performance indicators that you need to look at for your business to really be able to tell how well your business is doing and how healthy it is. These KPIs are not only important to help you really understand how your business is performing, but they can also help guide you in actionable insights for what to do for your business. So like being able to make strategic decisions based on looking at these numbers or these ratios. So here are a couple other examples. Your gross profit margin, your net profit margin, your debt ratios, your return on equity, the working capital or the growth rate. So there's a lot of these different key performance indicators, and it's really important that you figure out what the crucial ones are for your business. There are some that really do cover almost all businesses, but then there's a few that are going to be really important specifically for the type of business that you have. So for example, with my short-term rental business, right? Occupancy is an important key performance indicator for me. I need to know if my short-term rental is occupied for the entire month. What does that percentage look like? Is it occupied for 50% of the month, 60, 70, 80, 90, right? We want to know how we're doing in terms of occupancy every single month. So that's really important for us. So you need to determine which ones are important for you, which ones are important for your business, and then you'll be able to use the information from these three financial statements to calculate those key performance indicators and help you make better strategic decisions for your business. What we're trying to do here is proactive financial management. So the same as with your personal health, where there are things that you can do proactively to help ensure you don't get sick, right? Get good rest, exercise, get good, eat well, all of those things. We want to do the same thing with our business. We want to be proactively looking at our financial statements, looking at the key performance indicators so that we can see early if there is a problem. If we see, something's going on, we've got 1 month of a net loss. We can quickly address it, we can quickly change course and fix it so that we can ensure we have a nice, healthy, thriving business. Now, if you aren't sure how to run these financial statements or which key performance indicators you really should be looking at for your business, that's okay. Just head on over to jesslawrence.com and go ahead and book a call with me and we can chat and figure out the right ones for your business.